Hello, welcome to my channel. I cannot believe it is November already. Have you achieved your financial goals for this year? Have you made your 2021 RRSP or TFSA contributions? Today, I've invited Linus Yip, a certified financial planner with more than 10 years of experience in the financial service industry, to share his expertise about investing. Welcome, Linus, and thank you for doing this interview.
Thank you for having me.
So, how can beginners or people with minimal investment experience start investing?
I think the most important thing is to set up some ground rules and follow them. When it comes to investment, lots of people have their own strategies and they have their own experience. They share lots of things, and then sometimes makes it really complicated to lots of new beginners. My suggestion is to set up the basic rules. For example, there's a purpose for the investment. So is this for a short-term goal, long-term goal, or somewhere in between? So once you have the goal, then you know how to better allocate your money. And I would always suggest invest the money that won't affect your regular cash flow, so your life won't be depending on it. So it's better for yourself to isolate from the market ups and downs. And I won't suggest to chase the numbers, because people will hear about the news, hey, I make 20% in such as a long time or such as a short time. Then because chasing number will give us a blind sign when we just chase the return without knowing what is the actual risk underneath the investment products.
Sure.
Yeah, so give you a fun fact. I think for investment to generate 7.5% annual return, the risk actually jumps up 3 times between the year of 1995 and 2015.
Wow.
Yeah.
You mentioned short-term versus long-term goals, and I think that's very important because the investment options could be different. So what would be some possible investment options for short-term investment versus long-term investment?
Yeah. When it comes to short-term, I will always weight more on the certainty of the money. That means principal. If we can get principal guaranteed products, that would be great. Usually options are regular savings accounts, term deposit, or what we call GIC here in Canada, and also treasury bills or money market funds. However, they are not getting much return as what we used to have maybe 10, 20 years ago, but that's unfortunately the options out there. If it's a long term, that means you can invest it with the market, and even though there is a market correction or downturn happened, you allow yourself with the time to capture up with the losses. So in that case, I would suggest maybe mutual funds, ETFs, or some people may even do stocks.
I see. So what would be a reasonable risk versus return ratio, like in your opinion?
Yeah, it depends. If it's more conservative investment, if with a lot of bonds or low risk investments, it's really difficult to use that to compare with a higher risk, say equity investments in terms of the ratio. The ratio we usually look at is what we call a Sharpe ratio. It's a statistic tool that we use to calculate what is the risk-based return or return based on the risk that you are taking. Usually the number I will look at is as close to 1 as possible. 1 means you are getting the amount of return for the risk that you are taking. If it's above 1 means you're getting more return than the risk. And also comes down to the statistics. Sometimes people look at the 3 years average, sometimes people will look at the 5. 10 years may also give some insight, but as we know, the whole world changed quite a bit in the last 10 years. Say 10 years ago, YouTube was a new company, and then look at how big YouTube is right now. And
exactly. Yeah. And we are here during this YouTube video.
Yeah, exactly. Yeah. So I would say maybe a more reasonable to look at the shorter term period, 3 to 5 years average. Yeah, that would give us a better insight.
Interesting. And when you mention Sharpe ratio, this definitely brings back good memories from university days.
Yeah.
So in your opinion, is the time in the market or timing the market more important?
That's a very good question. And I think it really depends on the type of investors that you are. For beginners or people are busy with their life or they have other priorities to do besides investment, I would say time in the market is the better part. You will want to get your foot into the door as early as possible, so that your money will grow with the economy if you position your investment correctly.
Right.
Time in the market is kind of like hit or miss, because it's kind of like you make a buy or sell decision based on the information that you have on hand. And sometimes the information doesn't really reflect what the true market condition, and sometimes it doesn't really show until months later or even longer. So, for example, in February and March 2020, when the pandemic first hit North America, the stock market panicked.
Right.
And we dropped about 37% in a matter of just 5 or 6 weeks.
Right. I remember that.
Yeah, and that's the quickest, fastest drop in human financial history. Then also what happened is lots of people were panicked, they tried to sell, and lots of people were trying to get into the market. If you stay the course, if you stay with your investment goal, don't make any change, that's usually more like the time in the market strategy. So by November, those people will have recovered their losses already.
Right.
Because they didn't make any change, they just stayed the course, and they could even make a positive return for the whole year of 2020. If you are trying to timing the market, then market timing is really high risk. You either make a lot of money back in 2020, or it would take you years to recover the losses.
Exactly.
And lots of people, when they cash out or try to buy into the market, the market news there are not fully reflecting what the situation is. And as we know how strong media these days are, there will be a lot of news around, and sometimes it just makes people forget the fundamentals of looking into the company's financial report or financial statements, the part that you are good at the most, and just focus on pure market news and try to manipulate with the market and try to capture the market. But yeah, it's really, really challenging. And it doesn't mean that if you succeed for a time or two means you are going to be a pro. Still, Wall Street professionals, they get their hands burned because of the decisions they make. So
Let's take a break. We'll discuss retirement planning, TFSA, and RRSP in the next video. Thank you.
thank you.